Did you know that you could pull $20,000 from your retirement account and accidentally create $37,000 of taxable income? And yes, you heard that right. The scariest part isn't the math, it's that most people who do this have no idea it's happening until the IRS sends the tax bill. This mistake has nothing to do with investing poorly, market crashes, or running out of money. It happens because people claim their retirement income in the wrong order: 401k, Social Security, and then pension. Get the sequence wrong, and the tax system quietly punishes you for decades. By the end of this video, you'll understand why the order you claim income often matters more than how much you saved, the 3 hidden tax traps most retirees fall into, and how the right sequence can legally save tens of thousands of dollars over your retirement. Hey everyone, I'm David Cavanis, certified financial planner. When most people think about retirement income, they think in silos. Social Security is one decision, their 401k is another, and their pension is just something that shows up. But the tax code doesn't see silos, it sees combined income. For most retirees, income comes from 3 places. First, their 401k, their IRAs, their investment accounts, where every dollar you take out is taxed as ordinary income. You control how much you withdraw and when, but that flexibility disappears when required minimum distributions force withdrawals whether you need the money or not. Second is Social Security. You can claim as early as 62, or you can delay all the way until age 70. Claim early and your benefit is permanently reduced. Delay and your benefit grows roughly 8% per year after full retirement age. What most people miss is that up to 85% of your Social Security can become taxable depending on what other income that you have. Third is a pension, if you're lucky enough to have one. Most pensions are fixed, usually start automatically and are fully taxable. Individually, none of this sounds overly complicated. The problem is what happens when you stack them in the wrong order. Most people do what feels logical. They claim Social Security early because it feels guaranteed. Their pension starts automatically. They let their 401k grow as long as possible. It feels conservative. It feels responsible. And it quietly triggers 3 of the most damaging tax traps in retirement. The first is the Social Security tax torpedo. Social Security isn't taxed like normal income. Instead, the IRS uses combined income, your adjusted gross income plus tax-free interest plus half of your Social Security benefits. Once you cross certain thresholds, up to 50% of your Social Security becomes taxable. Cross a little more and up to 85% becomes taxable. Those thresholds haven't changed since 1983. For example, imagine a married couple sitting just under the $44,000 combined income threshold. They withdraw $2,000 from their 401k. That small withdrawal pushes them over the line. Now that withdrawal is taxable, and a portion of their Social Security becomes taxable too. That $2,000 decision can create $3,700 of taxable income. At a 22% tax rate, that's an effective rate north of about 40%. That's not investing risk, it's sequencing risk. The second trap is Medicare IRMAA surcharges. Medicare premiums are income-based and look back 2 years. Cross certain thresholds and Part B and Part D premiums jump. Even $1 over the line can cost a couple more than $2,000 per year. So what triggers it? 401k withdrawals, capital gains, and Roth conversions. What doesn't? Roth withdrawals and withdrawals of principal from taxable accounts. The third trap is the 3.8% net investment income tax. If your modified adjusted gross income crosses $200,000, if you're single, or $250,000 if you're married, you may owe an additional 3.8% tax on investment income. One poorly timed withdrawal can trigger it accidentally. This is how $20,000 quietly turns into $37,000 of taxable income. So what do you do instead? Often the smartest approach flips the sequence. Use 401k and taxable money earlier, delay Social Security, and build Roth as a long-term buffer. The most powerful planning window in retirement is the gap between when you stop working and when guaranteed income sources begin. Your income is lower, you control your tax bracket, and strategic Roth conversions can reduce lifetime taxes. Imagine retiring at 62 and needing $60,000 per year. You use taxable assets, modest 401k withdrawals, and convert additional dollars to Roth while staying within favorable tax brackets. You're not avoiding taxes, you're choosing when to pay them. Roth money grows tax-free, doesn't affect Social Security taxation, doesn't trigger Medicare surcharges, and doesn't create required minimum distributions later in life. If you have a pension starting at 65, this planning window shrinks. Once the pension begins, taxable income jumps and flexibility drops. Fast forward to age 70, you claim Social Security at the maximum benefit. Your pension is running, your Roth bucket is built, your IRA balance is lower. Your income now comes from Social Security, your pension, strategic Roth withdrawals, and smaller IRA distributions. You now have better control over your tax bracket, how to avoid or potentially avoiding IRMAA spikes, and keeping your taxes predictable. That's what optimized retirement income actually looks like. At this stage, retirement planning isn't about maximizing any one account. It's about minimizing your lifetime taxes while maintaining flexibility. Understanding these concepts is important. Coordinating and managing them over decades is where success happens. If you want a professional partner to help design and actively manage this sequencing based on your own personal situation, I'd love to have that conversation. Again, I'm David Cavanis, certified financial planner, founder of Cavanis Wealth Management. I'd encourage you to visit my website at cavaniswealth.com. There you can learn more about me, how we can work together, and schedule time for an initial consultation.